In the last video for Parker Company, we looked at the operating activities and we did it from the direct method. Now let's change gears and let's look at it from the indirect method. Now notice on our sheet here, we've already got our changes because we've already looked at this company and we've already talked about our changes. Now how do we do the direct method versus the indirect method? Well, the indirect method, when we say indirect, we're only talking about operating activities. All the other sections would be exactly the same. So there would be no change in our investing activities. There would be no change in our financing activities. The only difference would be how we represent or how we show our operating activities. Now, one thing to make a note of, when you look at this, we already know that our operating activities has to be 109 from the direct method. Now, how is this different in the indirect method? Okay, so we're going to present this in the indirect method format. Okay. So indirect method, so what we're going to do when we do the indirect method is we start with our net income and then we reconcile that back to statement or cash flows from operating activities. So a little bit different. So let's start with our net income. Our net income for this period, excuse me, is 80. Where do we get that? Well, go to your income statement, 80. So once we take that 80 in, we're going to take out any non-cash, so adjustments for non-cash items. In other words, non-cash operating items. And then we're going to look at changes in assets and liabilities. Okay? So what do we need to do there? Well, our non-cash items would be anything on our income statement that actually was not a cash expense. Most common, you've got depreciation, amortization, and depletion, those types of expenses, because when you debit the expense, you credit a non-cash account always. So depreciation will not be a cash event. So that's 40. Now notice 40 is an expense, so it reduced income. So how are we going to get rid of it? Well, we're going to add it back in. So our adjustments here for non-cash, first we're going to deal with our depreciation. So adjustment for depreciation expense. We need to add that back in because it was a subtraction. It was a reduction. Now, if we were subtracting out a non-cash revenue, we would need to subtract it out. So we're going to add that back in at 40. Anything else that we need to remove from our income that's just straight non-operating non-cash? Well, yes. In this case, anytime you have the gain or sell from a long-term asset, that should be an investing activity. So this 3 needs to be removed. Now notice it's a loss. So if we're removing the impact of a loss, we need to add. So anytime you're removing the impact of an expense or a loss, you add. If you're removing the impact of a gain or a revenue that's non-cash, then you would need to subtract it out. So we need to add this back in since it was a loss. And that would be added back in at 3. All right, now we have to take into account our operating assets and liabilities. So do changes in operating assets and liabilities. And let's talk about how those impact us. Now, for one, we'll look at, and you'll see debit or credit, and whether we add. But then there's a little rule you can remember going forward. All right, so let's start with what is our operating assets. Well, that's any operating asset that is a short-term operating asset. So just like we did in the direct, that would be your accounts receivable and your inventory. Remember, investments is an investing activity. Land and buildings are long-term. And then that would be your accounts payable, your salaries payable, your interest, and your income tax. Notes and bonds would be our financing activity. So we have to be careful. So any of those assets or liabilities that are directly linked basically to your income statement have to be accounted for. So let's start with assets. Accounts receivable went down by 2. If accounts receivable went down by 2, what happened to cash? Well, that means we have cash that we've received, not represented in our income statement. So you would credit the accounts receivable, you would debit cash, okay? So when you're talking about assets, if assets go down, you add them. If assets go up, you subtract them. So that's just the rule. When you're doing the indirect method, okay? So under the indirect method, let's just make a quick note down here. Indirect method. For operating assets, if operating assets are increased, you subtract. Okay? Therefore, if they decrease, you would add. Okay, so what happened here? Well, operating decreased, so we need to add it. So we would go down here and we would say a decrease in accounts receivable. So we're going to add 2. All right, any other operating assets? Well, we said inventory. What happened to our inventory? Inventory increased by 5. So if inventory increased by 5, what are we going to do? So increase in inventory, you do the opposite. If you increase the account, you subtract it. And we've been doing subtractions in brackets, so subtract. All right, what else? Well, that's it for our assets. Now we got to take into account all our liabilities. Now, so let's go in here. I'm going to add a couple more rows. Now you won't have to do this because the template you have already has them in it. Give me just 1 second. Just to make sure we have enough. All right, so now let's go through our 4 liabilities. We got accounts payable. Did accounts payable go up or down? Well, accounts payable went down. Now when we're talking about liabilities, here's the rule. So for operating liabilities, let's try and line this up. Equals. If you increase, you add. If you decrease, you subtract. Okay? So it's just a quick rule of thumb. You can go through in your mind and sort of do the entry, which we'll do on the first one. But rule of thumb, assets are opposite, liabilities are same. So if an asset goes up, you subtract, opposite. If a liability goes up, you add, so they're the same. So directionally speaking, anytime you have a change in asset, do the opposite on the statement of cash flow. Anytime you have a change in liability, you do the same. Okay, what does that mean? Well, accounts payable went down by 7. Okay, so it's going to be a decrease here. So we're going to say, hey, a decrease in accounts payable. So therefore, we are going to decrease it here. And I don't know why the formatting's different. Let's see if I can fix that. All right. All right. Notice it is exactly the same direction for a liability. Asset decrease, do the opposite. Liability decrease, do the same, decrease. All right. Let's do the next one. Salaries payable went down by 3. So that's another decrease. So we're going to go down here. We're going to say decrease in salaries payable. And since salaries payable decreased by 3, I'm going to also decrease by 3. All right. Next, we have our interest payable went up by 2. So it's an increase in interest payable. So increase in interest payable. Since it increased, I'm going to do the same thing. I'm going to increase by 2. And last but not least, we said our last operating liability was our income tax payable. It decreased by 3. So therefore, we're going to go in and say, hey, we are decreasing income tax payable by 3. So we also need to decrease our cash. Okay. Why is that? Well, think about payables. When payables decrease, you have to debit them. When you debit a payable, what would you do with cash? You would credit it because that would be your offset, which means your cash is going down. All right, so now we've already got our check figure from when we did the direct method, the 109. So let's just double check and see, are we close? So take your 80, you add your 40, you add your 3, you add 2, subtract 5, subtract 7, subtract 3, add 2, and subtract 3. And lo and behold, you get the 109. So notice the indirect method is a little bit different in format. So right here is our cash flows from operating in the indirect method. Keep in mind, investing and financing are not touched. They are the exact same in both methods. Only the operating activities have an indirect method. Most of the time, or if you do the direct method, you still have to do the reconciliation to prove out that your direct method is correct. So you also have to do this regardless, okay? So that is how we reconcile back. When a problem says reconcile the direct method to income, this is what they mean. Do the operating activities for indirect so that you can prove out that you come up with the right number, okay? So that is our 2 methods. This video is much shorter because the only section we looked at was operating and how to change that. Now in video 3, we're going to do an indirect method. And really we're doing it simply because it is a very in-depth problem so that you can really get a feel for what goes on when you have a really difficult balance sheet. So make sure you pay attention to that. All right, hopefully you understand a bit more about the direct and indirect method of creating a statement of cash flow. Thank you and have a great day.